What are the financial planning trends of 2024? We will dive in on this podcast. So welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while sipping his matcha. This is Through the Pines. Want to welcome in our financial planners this podcast episode, Brandyn and Rex, or should I say Rex and Brandyn, from Smith and Baxter. Yes. Is that how it goes?
That's we're making a couple changes.
We're making a couple changes. From Baxter and Smith, or Baxter and Associates, whatever, however you want to say it. Rex, introduce yourself. Tell me about your business.
So we are Baxter, Porter, Smith and Associates.
Okay.
And we're with Ameriprise Financial.
Yeah.
We run a great financial planning and investment management practice in our industry.
Okay.
We've been named Forbes.
Yeah.
Best in state.
Yeah, for 2023, 2024, Forbes Best in State Wealth Management Teams for Utah, as well as the Advisor Hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award. What is that award?
So that means that we take really good care of our clients.
Yeah.
So Ameriprise internally measures customer service on a number of different data points. Mm-hmm. And we're one of a very limited number of practices that have won that since they put it in place, mm-hmm. which was 3 or 4 years ago. And we've won it each year. And there's really not that many practices that have won it each and every year, the last 3 or 4 within Ameriprise. Ameriprise has about 10,000 different advisors across the country.
Yeah.
And so it's a fairly large firm that we're affiliated with. And we run one of the top practices in the firm. So
you guys know what you're doing.
Yeah.
Okay, good.
I feel like it. I hope so.
Yeah. This is good. So we're going to talk trends here. What are the financial planning trends of 2024? Holistic planning, virtual meetings, AI, client services, coin and alt investments. So let's start with like a holistic approach. And I don't think this is new, but I read this in an article that this was a trend. In other words, you're focused, when you meet with clients, I'm assuming you're not focused on just investments. And how long has it been? Has it always been like that? Like where you dive into estate planning and other things that are not just their investments?
No, can I take this one? So
no, you can't.
I'm fascinated by it, right? Because I've been in the industry, I've been with 2 different companies, but I've been in the industry for about 14 years now. And so those last 14 years, it was interesting. As I came in, everything was shifting towards like more financial planning, and people want financial planning, and so I'm fascinated by it because it was kind of before my time. But you've seen, what's that movie, Pursuit of Happiness or something, where he's running around and he's calling everyone like, hey, I got this cool stock for you to buy. And that's how it used to be, right? I've
just stock buying, or just
right. Like you call, like
okay.
You're calling clients saying, "Hey, I've got a new stock mm-hmm. that you need to buy," and it's because your firm bought like this huge boatload of stocks, and it's their job to disseminate those stocks into and to essentially, it was like a bunch of sales guys running around trying to pawn off, sell stocks. Like it's just wild when you look. I've talked to older guys in our industry who are like, yeah, we didn't even have social security numbers for half the people. We would just like open up an account and put zeros, and they're opening accounts right and left. They're selling stocks. I mean, it's crazy how refined our industry has become over the last few decades mm-hmm. to where it went from like a sales type thing to a fiduciary level. Fiduciary meaning not only are we morally obligated to do what's in your best interest, but legally obligated to do what's in your best interest. And it's putting the client first now, and we're doing financial plans and saying, what do you need, rather than just trying to push products and sell stuff. And there's still guys out there that are still kind of on that old model, and you can see them, right? Like when you talk to them, you know who they are. But I love that our industry is becoming so much more client-oriented, client-focused. How do we help you and remove conflicts of interest?
Yeah, Rex?
All right, I'm excited for this podcast because the energy in this trailer is electric.
It's
so this is going to be fun because Brandyn is kind of surprising us with a few of these topics and questions, and yet other Brandyn and I are very passionate about the business and where we've been and where we're headed, and we're excited. And so, to answer your question, I've always ran my practice to some extent with with planning on one side and investments on the other. And so, one of the first questions we always ask our clients when we meet with them is, one of the very first questions is, what do you want to make sure that we address today and that we don't skip over, right? So that whatever their primary concerns are, whatever's keeping them up at night or causing anxiety, that we make sure that we get that addressed and taken care of. But the industry has changed drastically over my 27 years. And prior to my 27 years, right, you had stock brokers and penny stock brokers, especially in the state of Utah. There's a big penny stock exchange in the state of Utah, one of the biggest in the nation, to where you'd buy 10 cents of, which would be 10,000 shares of some mining company and things like that. And everybody would, get a hunch and bet a bunch and all these different sayings in the industry, and so
I haven't heard that. I like that one. Yeah, that's good.
so some of these may make a playback here today, during this podcast. So listen close, and you may catch a couple of gems.
Yeah. Okay, good. So how holistic does it get? Like, do people call you and say, Rex, how much should I spend on a wedding? Like how deep, how broad do you get with your financial planning now?
Yeah, we get as detailed as the client wants to get. And so if, I have 4 daughters myself. And so in my own financial plan, I have a set limit as what I'm willing to spend on each of those daughters.
Yeah.
And just for my daughter's sake, you all get the same amount. I don't have a
Keeps
favorite.
going up. Yeah.
I do not adjust for inflation. I should.
Okay.
So, but or I offer to cut a check and they can go to Vegas and just use the money however they want to use the money.
Well, I like that idea.
And but they get that choice, right? Yeah. And nobody's taken me up on the check yet, but I have a feeling that one of my kids, one of these days, is going to take the check.
Yeah.
But we absolutely put that number into the financial planning. We have people call us up and say, "Hey, Rex, I'm thinking about buying a truck. It's going to run me $80,000. Is this a good year to do it? Should I do it next year? Timing is I'm a little bit flexible on." Or the other situation of, "Hey, Rex, I bought a truck. How does that impact my plan?"
Yeah. More likely. That's the post question, right? Like, okay, now I got to tell my financial advisor what's going on.
Right. It's the booth.
Yeah.
Right. They've got to come in and divulge all their sins. So
usually,
oh my gosh, that's not good.
Usually we're walking clients through and holding their hand, right? We have some clients that are very competent and like they, as far as investing goes, right? They've got an extensive background in it. They're like, this is what I need. I could do it. I just don't trust myself, or I don't have the time, or and this is the rate of return I need. Here's the risk I need. We have some of those, but not very many. The vast majority of people come to us and like, I don't get it, right? I don't get investment management. I don't get the markets. I don't get the econ. I don't want to get it, right? I want to have someone that I trust look at me and my situation and build a portfolio accordingly. And that is where, because Rex said, I've always had the financial planning and the investment management, and that's how we always present it to our clients. But the reality is those two things are so combined. Like in order for me to build a good investment portfolio for you, I need to know what your future financial needs are. And so really those, yes, they're two kind of different entities, but they merge so much because we need to know what your future distributions are and what you feel, the emotions you go through as markets shift. And so that's our job, is to truly, more than just like, if we're just the best investment managers in the world, that still doesn't do it, because we need to know what you need. We need to know how you're going to react to different situations. We're going to need to know what your portfolio needs to be capable of as far as distributions and future things like that. And unless we pair those together, it just doesn't work.
All right. Well, then talk to me about some of the portfolio trends in 2024. Are they changing? Are they the same?
Yeah. So a huge trend that's kind of fun to follow is, you've heard of the Magnificent Seven.
Yes.
Right? The 7 big tech stocks that are responsible for the majority of the rate of return. Mm-hmm. They're also responsible for some of the overvaluation in the general market, right? You look at the market and you're like, wow, the price earnings ratios, which is how much are we paying versus how much is the company earning, they're kind of elevated. And a lot of that comes because these Magnificent Seven have grown their earnings like crazy over the past few years. and they're projected to continue to grow at that. And so investors have compensated for that and said, wow, well, if they're going to continue growing like this company's actually worth more. And so you've seen their prices run, which has kind of brought the whole market up with that. But then people are like, wait a minute, is the market overvalued? And so, sorry, this is a little bit scattered, but yeah, I mean, it's the Magnificent Seven is this time period's kind of, it's an interesting time where it's not necessarily the full market, but more of a concentrated group of stocks that's responsible for most of the growth.
Interesting.
It's interesting to me how that has changed in people's retirement plans, like 401k plans and things like that, because a lot of those are not automatically rebalanced, and a lot of people manage their corporate retirement plans in a rear view mirror, right? And so they looked and say, what did best for me yesterday? I want some of that. It's called the, give me some of that syndrome, right? And so whatever did 100% last year, I want that, because certainly it's going to do 100% again next year, and rarely does it ever, right?
Yeah.
And so we're starting to see a lot of people get overweighted in some of these riskier areas and not staying true to form of rebalancing and diversified portfolios and managing their risk appropriately is what we're starting to see. And that's very, very common. That's human nature. That's one of the tenets of investment management and portfolio management is that you stay true to your knitting and there's an old saying.
Yeah. I don't even know what that means.
We'll trust it.
And so, but then they don't, and they get overweighted, and then they get extremely frustrated when all of a sudden somebody says, you're down 40% and you are taking way more risk than you recognized. And it's because they're not paying attention to what the underlying holdings of these mutual funds are inside of it. And they've purposely, unknowingly, but purposely overweighted the riskier assets. And so that's some of the trends, the unknowing trends that I've seen in portfolio management. The knowing trends that I'm seeing from advisors across the industry is I'm seeing some advisors starting to use a little bit more in metals because of the inflation of the last couple of years, that they've started to use things that they perceive to be possible inflation hedges. I'm starting to see a little bit more in some of the, I guess, some of the outliers of the industry. I'm starting to see a little bit more weightings towards alternative investments or even digital currencies or things like that. We don't play in that world, and we're not, those are risks that we're not comfortable taking with our clients.
You're getting ahead of me on this.
I know, but we'll come back to it again, because it's probably a piece that you have more questions on. But that's one of the trends that we're seeing in portfolio management. Right. And so trends are not necessarily good or bad. They're just trends.
Right.
And so just because I'm saying that this is something that I'm seeing, that doesn't mean that that's what you should be doing. And so make sure that you take that away from this conversation, that just because a crowd jumps over a cliff doesn't mean you need to jump over a cliff.
Right.
But they made money doing it. So
Maybe.
You never know. I just heard an argument a week ago or something about 401ks in 2024 and that they should not be your retirement plan. And their argument was that it should not be your entire retirement plan. In other words, a lot of people use it as their retirement plan or their only retirement plan. And her argument was, well, it should be a portion, but really you should invest in Roth IRAs and some other things in the market. So what are your thoughts on that?
Man, I think there's a lot of things going around the internet right now.
Well, this was an interview on TV.
Oh, was it really?
Yeah.
Okay.
With the financial planner on TV, but yeah.
Wow. So originally, the government had it envisioned as a three-legged stool. You had Social Security as one leg of your retirement.
Yeah.
You had a pension as one leg of your retirement, and you had your personal savings as one leg of your retirement.
Mm-hmm.
And so that was back in the 30s and 40s and 50s. As we get into the 70s, the invention of the 401k, or I shouldn't say invention, but the creation of the 401k and IRA accounts came to fruition. And at that point, we started to see a migration from pensions to 401k plans, which I would incorporate IRAs and Roth IRAs into typical retirement planning. And then you should still have your personal savings on top of that. But I feel like 401k plans are extremely valuable on a couple of fronts. One that Brandyn says frequently is make it automatic.
Yeah.
And that's one of the easiest ways to make your savings automatic. Plus, a lot of companies, do additional company matches or contributions into that 401k plan, which is essentially a raise for you, that to where if you put money in, they're going to put some additional money in. And so you're getting an automatic bonus, if you will, into that retirement account for you that you're not going to get anywhere else.
I think part of her argument too, and I should have explained this better, was that people will use the excuse of saying, "Hey, how's your financial planning?" Or I have a 401k. That's all they need. They don't need financial planning. They have a 401k, and that's it. It's not reviewed. We don't know what's in it. We don't know what the returns are. They just know they're putting a percentage away, and that's their retirement plan. But really, there's more to a retirement plan than just having a 401k.
Oh yeah, retirement planning is complex.
Yeah.
Right. And so into that, and I'm curious to hear Brandon's opinion on this, but into that comes taxes, right? Where's your tax rate today versus your tax rate tomorrow? And are we going to get the deduction through the 401k plan or traditional IRA versus a Roth 401k plan or a Roth IRA? And so that's going to play into where should your savings be, which account type is the most efficient way for you to save your money. And at the end of the day, based on your current spending rate, that dictates how much of your money should be being saved. But then we need to figure out which channels it should be being saved in to make it most efficient based on what you want to do. If you want to retire at age 50, then we better make sure that we're saving money outside of a retirement plan in addition to inside the retirement plan, because it may be difficult to get without additional tax hits outside of that retirement plan.
Yeah, Brandyn?
Yeah, I think taxes are what people don't understand is just how much flexibility and capabilities we can find within an IRA or a 401k. One of my biggest pet peeves of all time, I'll ride around, like, listen to the finance radio on Saturday morning. My wife hates it because she's like, "Oh, you were listening to them again?" Because I'm like all worked up, Sometimes you get people that want, in the name of tax diversity, right, creating some of that after-tax money, they're having people pull money out of 401ks early, or they're taking all of the tax hit all at once, like to pulling it all out. And it's crazy because we can do that most times within a 401k. We can do a Roth conversion, convert it from pre-tax to Roth. Now, not always, but a lot of 401ks allow you to do that. Outside of that, you can move money into an IRA, and you can do a Roth conversion. You can move money from an IRA to a Roth. Now, in the year you do that, there are tax consequences, right? So we want to make sure that we're prepared for that. But it drives me crazy when I hear people like citing taxes as the reason not to use a 401k. It's like, no, a 401k is one of the most tax efficient vehicles out there. And if you want that tax diversity, we can do it. Let's just make sure we understand all the pros and cons. We don't need to buy some sort of crazy product that's being sold out there. We can do it within the 401k, within the IRA, and have just as good or better tax situations in the outcome.
Okay.
It's interesting. So one of my contacts on social media shared a social media post from apparently an influencer. I'm not smart enough to know what an influencer is, but so somebody will have to explain that.
You are one,
Rex.
Yeah, so you know.
Very
So, but this influencer was essentially saying, do not save in a retirement plan. It's the worst place ever for you to save your money. In a 401k, it's the worst investment you could ever make, was the advice that he was giving. And his premise was that our tax rate's going to go up in the future. And he was stating as fact that absolutely tax rates are going up in the future. Tax rates will be higher, and you're going to end up paying way more in taxes down the road than what you're paying today. And there's significantly better things that you can do with your money. And
like what?
And he wouldn't say on the post,
because they want to sell you their dumb product and they don't want to say it.
Yeah. And so it's interesting to see. So he was, as I dug into it, it took some serious digging, a little bit of internet sleuthing, right, to kind of figure this out. But it looked like he was promoting physical gold and life insurance policies is what he was kind of promoting in this situation, that was the cure-all for the entire population of what ails you. And what I would say to that is rarely does one product or one solution work for an entire population of a country.
Yeah.
Right. And so everybody is a little bit different. Their situation is a little bit unique. And that may be right for some people. Probably not many, but it may be right for some people.
Yeah.
And so, but boy, he was so passionate and so certain.
Right.
It's one of those guys that is rarely in doubt, but very possibly frequently wrong.
wrong.
Yeah.
Rarely doubt. So, but with that, right? Like, and I hear that all the time. Our taxes going up and down, and I would agree. I think given the debt and given everything, I think tax rates go up. But that might not be true of you individually, right? You individually, if you're 50, 60 years old, you're in your highest earning income years. Is your tax rate going to be higher or lower in retirement? It depends, right? Our favorite answer. It absolutely depends. The way to think about pre-tax money, like a traditional 401k or a traditional IRA, is we are deferring tax until later. And some people might say, hey, that does not work for me, right? I'm really worried about what taxes for me are going to be in the future, and that's fine, right? Then choose the Roth option. Basically, every 401k out there has that.
Yeah.
And then you have no taxes in the future, right? We don't get the tax deduction up front. It grows tax free. We pull it out tax free. But there's a lot of people who are like, man, I'm getting killed with taxes. Maybe I haven't saved enough. If I could just simply defer paying tax on this income for 5 years or 10 years or 15, like that might be a really beneficial thing. And that's where the financial planning comes in, right? There's not a one size fits all. It really depends on where you're at individually.
Okay, Rex, let's talk technology as far as, so really a big boom in like virtual meetings during COVID, right? Because we had to. And so now that's sort of become an everyday thing, right? Like how many virtual meetings did you do 5 years ago as compared to now?
So I might be the wrong guy to ask. I went.
You're not there yet.
I went virtually with the vast majority of our clients back around 2009, 2010.
Oh, you were early.
And so I was an early adopter with virtual technology. I used Cisco WebEx back in the day and different things like that. But I've been an early adopter of that. And so I would say even today, probably 80 to 90% of my client meetings are virtual. It just saves so much time on the clients of not having to, leave their house,
gotta clean
drive
the house,
into the office,
or go to if you go to their house, you gotta clean the house.
Right. Yeah. All of a sudden, instead of, they got to kick everything under the table, So it saves a ton of time. It's more convenient for most people. There are some that are uncomfortable with that.
Yeah.
And I will say that there's still a lot to be said for reading body language when you're sitting in the actual room with the client. And so it is nice to still be able to do that when we need to. When there's something significant going on, then most of the time I'll be in the house or they'll come into the office, whatever the case may be. But I mean, I went virtual a long time ago.
Yeah.
So
I think it's nice too, because now the population is more or less comfortable with virtual meetings, and so when we say, "Hey, can we send you a link?" They're like, "Oh yeah, that works."
Right.
Which is nice too, because we have a lot of clients that are living here, but they're like, "Yeah, no, in retirement, I think I'm moving. I'm moving somewhere warmer,
right,
where there's no snow." And we're registered. I think last time we checked, 38 states.
Yeah.
And so it just makes that so much easier, right? That we can have clients basically anywhere. And still take
and out of the country.
Yeah.
Well, there's some regulation issues with people out of the country, but as far as what can
but
be
they
done,
can call you, right?
Yeah, but they could give us a call and we can talk through things
virtually,
things like that. Yeah. And so we can still do that. Certainly capabilities are there without question. And so it's more of a factor of US regulatory groups keeping up with technology, which I think is extremely difficult for the government to keep pace with technology.
Oh, the government's pretty quick, so get right on that.
Which government?
all governments. Yeah. Any other technology that you've seen in your office or something that's really helped improve or the processes or make things a little easier?
I think even the planning software has come a long ways.
Yeah.
Over the last 20 years. And so you look at some of the planning, software that we were using in the 90s, to where we, the Monte Carlo simulations and some of the inflation adjusters and things like that has gotten a lot more complex over the last 20 years and a lot more accurate over the last 20 years. And so plus it's a lot more user friendly. It's a lot more visually appealing as far as the output and what's being used and how to show it, and which is helpful because it just helps clients. Some clients are number people, some clients are visual people, and it kind of ties those two together so that whichever your personality type leans towards, we can still show the kind of compelling story of where you're headed in either format. So.
What about AI? Because that's obviously everyone's using it. Everyone except for the financial industry, maybe.
Now you're not talking about Allen Iverson, the basketball star.
Wow, you're taking us back. Yeah, no, definitely AI, artificial intelligence. So
no, I'm excited for artificial intelligence, and see the thing with our industry is we do need to be careful, right? And we also need to make sure we always understand the software. We've got amazing software. It's so fun. It helps us challenge our thinking, right? You put it all in, you're like, wait, how is that? And you can dig in and figure out exactly why. But I think there's a danger if you ever just trust technology explicitly, right? When we do financial plans, we run it, but then I'm always kind of in my head, and after the meeting, okay, I've got this much in assets, I can take distribution rates of this, and are all these numbers coming together like they should be coming together? And so it'll be fun to see AI, because I think what AI does is it enhances new ideas, right? As far as in a financial plan, we put all the information in, and it gives us hopefully a list of, hey, have you considered this, and this, so we can go through and so those things are kind of starting. They're not quite fully developed yet, but we get reports and things of like, hey, make sure with these clients, make sure are these investments lined up, and so it's fun to watch it, but there's still a lot, I feel like, to come.
Yeah, I think AI will enhance and revolutionize our industry, is my opinion, and I think that's just on the front edge of things at the moment.
There's not a lot, right?
And so I think most firms are trying to control and understand what that means and what that business model looks like over the next 5, 10, 15, and 20 years. And they're trying to set the stage to remain compliant from a regulatory standpoint and from a security standpoint, and yet still try and use this phenomenal technology to enhance our clients' lives. And so the ways that we're seeing it today in our lives is as advisors, our back office will run multiple reports that these clients may be at risk of leaving the firm, kind of thing. And so you need to reach out to them, make sure that they're engaged and things like that. And sometimes the clients are fully engaged just at the level they want to be, and maybe not the level that the AI thinks that they should be, kind of thing. And so from an advisory standpoint, that's extremely helpful AI knowledge and technology to make sure that the clients really are engaged and happy with the relationship and being taken care of in the way that they want to be. I think AI will eventually, in my opinion, isn't going to be able to replace the interpersonal relationship between an advisor and a client. I think it will be able to do the math. I think it will be able to do a lot of the planning, but it won't be able to take into account the emotions, and it won't be able to take into account the inherent biases that clients develop over their lifetime. And so I think AI will be able to tell you financially what may be best, but we don't always make decisions based on what's financially best. Sometimes we make decisions based on what feels good and what our comfort level is, and things like that, like paying down a debt. Maybe you've got a 2% interest rate and you can make 5% in a CD. Financially, it may make sense to have the CD and to retain the debt. And yet AI may come in and say, absolutely do that. And somebody's background may say, no, I want to be debt free. I want to make sure that that's paid off. That's a weight on my shoulders. I'm uncomfortable with it. And I'm not sure that AI is ever going to be able to fully comprehend those dynamics inside of a person.
So that's the difference between, so that's how you keep your job. In other words, someone or some software will come out that's AI driven, that someone can put all their stuff in and it'll spit out the numbers like you say, and it'll tell them exactly like what they should be doing according to the numbers. But then, the personal, how what do you offer that's outside of the numbers that keeps financial planners in business, I guess?
So the problem, you say they put in all their numbers, like that's the problem, right? Like there's all sorts of softwares out there where you can put in your numbers, but it's like, well, what are the assumptions? What is the Social Security assumption? What is, and did you put in the right number? Because we do a lot of 401k plans, right? And they all have that kind of free financial planning software, and it's good, and we kind of push it out. But it makes me really nervous because I don't know, like in fact, I just was at a meeting with a client, and they're like, oh yeah, I won't name the name, but my 401k said that I'm set for this in retirement. And so we dug into it, and he's like, well, do I have that? And it had duplicated, added another few $100,000 to the plan because he had input like an account that he had, and then it got consolidated. And it's just all of those things, like the data, what goes in is just as important or more important, than what comes out, right? You have to have the accurate data. You have to know, is this pre-tax, after tax? What are the, there's just so many inputs that can get mixed up. And so I'm not saying we can't be replaced, never say never, but I think it takes a while before the financial literacy of the population gets to a point where they can accurately input data and understand the results.
Yeah, and like you mentioned earlier, that some people just don't even want to deal with it. They don't.
Right.
They'd rather just hire someone, and they don't want to have to pull up the AI and put the numbers in. They want to call a person.
Right.
So.
And some people like that. So I think on both fronts, you've got the good data in, good data out problem, right? As far as that goes. I think the other is you still have to direct the AI, and so you still have to know the right inputs, the right questions, the right phraseology to use to get the output that you're looking for. And so I think that takes some education and some experience and some knowledge to get through. And then you've got the psychology of it.
Yeah.
And I think that over time, and I think this is a long period of time, because it's taken us 50 years to go from broker to more advisor and planner. And my guess is it doesn't take another 50 years, but I would imagine over the next 20 years, we go from advisor and planner to more, counselor, guider, advisor, planner combination.
Yeah.
Over that next 20 to 30 years. I think that the psychology of it and the counseling of it and kind of mentoring and holding people's hands through these different periods, I think becomes a bigger and bigger part of our role over time.
Okay, what about people now in 2024, and they have for a while, but they've got this appetite for information and news. So you surprised me, Brandon, when you said earlier that it's a small percentage of your clients that like know all the things, right? That they lean on you for that information. But there are people out there that, there's, 7 or 8 different financial news channels you can go watch every day. You can jump online and search all the things. You can use the AI. So people should be, you would think, more familiar with finance and financial planning and stuff. But, what does that look like in 2024 when it comes to helping your clients?
The problem, and I'm all for, I love when clients are learning and listening to great podcasts and watching, financial news things and watching movies about, right? It's fun because that literacy does help. The problem is that's more entertainment value, right? Like it's like kind of highlight little point, but there's a lot more in-depth stuff that's not as shiny, that's not as easily digested, that's not as and that's what it takes, right? It takes more than just having a good hunch on a stock or a good feeling about a earnings ratio, or it takes a lot more to really build a portfolio that you can confidently go into a major downturn in and have confidence that we've cross-checked this thing every which way for diversification between sectors and between geography, between company capitalization size. There's just so many different things, and you need to have just such high amounts of confidence going into rough times so that you can get out the other side without making a really bad decision. And so I think it's really good for people to listen to podcasts, to do all these things, but it's not enough. There's quite a bit more that needs to be done in order to get through the good times. Anyone can go sail on a perfect day with, 6 knots of wind from the, and you're just on a perfect beam, right? Let's forgive all the sailing terms. But when the weather is beautiful and it's just easy going, and it's like, hey, tug on that line a little bit and you'll trim your sail, and then there's that. But what happens when you're in the storm?
Yeah.
Like, what happens when all of a sudden you're looking at these waves that are coming and they're coming over the front of the boat, and you're like, oh my gosh, like, am I ready for this? Am I ready to sail through this because we've got to get to the other side? Or are you going to throw the white flag and, jump out in a tube and just float off into the middle, right? Like, this is the worst analogy ever. I apologize.
I mean, you're rolling with it. I expected it. Respect the dedication.
Yeah, I thought this died a long time ago. Keep going.
No, it's
keep going.
I'm halfway through. No,
I'm halfway.
no, you've got to have the confidence to get through it.
Yeah,
Otherwise, really bad things happen to portfolios.
Right. Yeah. Rex?
Different strokes for different folks.
Yeah.
Right. And so
Yeah.
I think that I've changed a starter in my. You use sailing. I'm going to use a Jeep. Right. I changed a starter in my Jeep when I was younger. Do I have any interest in doing that now? Could I do it now? Could I watch a YouTube video and figure it out? Absolutely, I could. I have zero interest in doing that.
Yeah.
I'm absolutely willing to pay for somebody else to do that for me.
Right.
And I think that those are the people that seek out our advice and our guidance, is the ones that either aren't confident, don't have the time, don't have the interest in doing it themselves. And I think that that's going to continue. I don't think that's going to change.
Right.
I think there will be a certain group of the population that will absolutely watch the news channels and will allow AI to be engaged and at a very intimate level in their financial lives. And that's great. That's great for them, and that's probably a good fit for them.
Mm-hmm.
And we may not be a good fit for that person. Now, we may end up cleaning up a mess for them, 5 years down the road.
Yeah.
But that's typically not who our typical client is. Our client is are smart people. They're people that they have the ability, but they may not have the interest, desire.
So just because they have the access to the information doesn't mean they have the time or the want to use it all.
Right.
Well, because you've seen study after study after study, individual investors on their own consistently lag inflation with their investment returns. Like, that's pathetic. It's so bad. And that's average. That means that there's a lot, and I've seen a lot, who get dramatically negative returns consistently. And why do they do that? It's because they don't know what they're like, kind of have a hunch, and they're kind of watching some videos, and they're like, okay, I think this will work. And then something goes south and they abandon it because they don't trust it. They don't understand what, and maybe rightfully abandon it, right? Because they didn't build it right going into the storm. And so I in order to do it yourself, you got to make sure that you got the expertise, that you've got the confidence to do it. But even that, I'm a numbers guy, right? And kind of a statistics guy. And if I'm looking at something saying, man, the average person lags inflation on their investment returns, and I can pay someone 1% to actually hit my goals confidently, I mean, you're going to have quite a bit of confidence that you're going to be that much better than the general population. And so I think for a lot of people, it's more of a logical thing where they're just like, look, I don't think I'm going to be that much better of an investor than all the other people trying to do it on their own. Mm-hmm. I'd rather just kind of like bow out of this one, defer to a professional who I'm confident can hit those rates of return I need for my retirement goals.
A lot of it comes back to Warren Buffett's fear and greed, right? And the masses of people. Is fear and greed drive the market, and he wants to be greedy when people are fearful, which means the market's down, and so he's investing. He wants to be fearful when people are greedy, which means the market's up, and so he's nervous, and he's probably amassing cash during different periods like that. And then the fact is that people are emotional beings, and so they very frequently do the exact wrong thing at the wrong time. And having a unemotional person involved with your finances, not saying that I'm void of emotions, but I'm not very emotional about your personal financial situation, other than I do want what's best for you. Yeah. And I do have that fiduciary responsibility to do what's best for you and give you the best advice that I'm capable of giving. And so we want to do that, but it does mean that, we were talking to a client yesterday that back during the 2008-2009 crisis, right? They ended up selling everything. They thought they were diversified. They ended up being down significantly more than what they thought they were going to be. They panicked out. They weren't sure where it was going to end. They hit their limits. They sold out at the bottom. End up compounding that problem with another, poor investment choice. And I think it's being able to hold people's hands through that and say, look, here's what history has shown us. Here's what the higher probability is that happens over the next 5, 10, 15 years. And here's when you told us that you probably need those funds. And so, if you're taking more risk when you come to us, let's have that conversation. Is now the time to de-risk, or is the time to de-risk 2 years from now or 5 years from now, right? And so we can kind of go through those different questions.
Brandyn, do you have interesting SMORE numbers?
I do.
Okay.
They are actually very interesting.
Very interesting.
So this, and we kind of mentioned biases earlier, and we're this is when this recording is happening, we're going into an election season, right? And so you get a lot of different biases, a lot of people saying, "Oh man, if this happens, then I'm doing that." And so this is kind of interesting. It's maybe a little bit of an exaggeration, but First Trust put together this piece where they said, "All right, what would happen if you invested $10,000 in 1949? And there's 3 strategies. One strategy is just to leave it and do nothing.
Like in the bank?
No, invested in the S&P 500. So
Okay.
invested in kind of the market, right?
Okay.
U.S. large companies. Invest it, do nothing. Just let it grow. The other is to strategically say, I'm only going to be invested while a Republican is in office. And as long as a Republican's in office, then I'm going to keep my money invested. And the others, I'm only going to invest when a Democrat is in office."
Oh, this is going to be...
Right?
This is a good by the
Yeah.
numbers,
By the numbers.
especially during an election year.
Right. And I think the reason this is worth going over is because although it's an extreme example, there are people who are like, man, when those dirty, rotten blank, right, get in, then the economy's going to crash. And this,
Do
whatever.
people just pull all their money? There's no way.
Oh,
Some
absolutely.
people do.
Some do.
Are you
Absolutely.
serious?
Yeah. They come at us and they say, look, I do not trust this political party. And the audience can fill in either political party.
right, because we hear it from both.
and so therefore, if this happens, I want to go to cash, right?
Really?
Or
Yeah.
I want to go to gold, or I want to go to CDs, or I want to, I want out. I do not want to experience whatever they bring to the table.
Interesting. Okay.
So you want to hear the numbers?
Yeah.
So if you stayed invested while a Republican was president,
Wait. We want to know, like, if you never pulled your money.
no, that's last.
You want to do that
That's
last?
the real punchline.
Oh, that's the punchline. Okay.
Yeah, don't ruin the punch.
Well, I was going in reverse.
So if you only stayed invested while a Republican was in the presidency,
Okay.
when a Democrat gets in, you sell. Your 10,000 would grow to 83,360.
Okay. What's the return on that? Is there a percentage?
I don't know.
Okay.
Not very good.
Not very good.
If you did just the opposite, if you only were invested while a Democrat was in president, and anytime a Republican was up, you sold to cash, it would have grown to 414,000.
Well,
So
that's a
actually
lot.
better. Yeah, a lot better
Yeah.
in that. And this doesn't take into account, percentages of how long each, right? But if this is your investing strategy. So 83 for a Republican in office, 414 when Democrats in office. If you just stayed in and did nothing, right? No matter who was in presidency,
Yeah.
grows from 10,000 to $3.46 million.
Ooh, yeah.
Dramatically
Yeah.
different. I mean, we're talking 83,000, 414,000, or $3.46 million.
Wow.
I mean, and it's just, and it sounds great, right? You're like, well, why would anyone ever just stay out of the market for a long amount of time, right? Apple's still going to be making money. Ford's still going to be making trucks, right? Like, why would you get out of the market? And that's a very logical thought, but people do. People are like, no, this person, when they get in, I've been listening to some politics, and the world is going to end,
Yeah.
right? And it goes on
Oh,
both
it's a
sides,
shame.
both sides of the political aisle.
Yeah.
And it's just a horrible investment strategy.
Okay. Well, hopefully everybody learned something here with that example.
Things
Keep your
not
money in
to
the
do.
bank. Keep it invested. Interesting. Okay, so trends for 2024. I mean, we can't not talk about coin or alternative investments, Rex.
Yeah, I think
Do you get this question like every day now, or?
quite frequently, especially as some of these are starting to make their way through into exchange traded funds and into the market in different ways,
Yeah.
right? And so we certainly get the question a lot of what kind of cryptocurrencies should I be doing and how much and things like that, and because they're not regulated in all the states, then our hands get tied because we're licensed across the country to where we're not able to give advice and guidance on cryptocurrency and digital currencies. I think big picture trend wise, I think it's going to be really interesting to see which cryptocurrencies survive, right? Just like back in the car making days, we had 100 car companies that whittled down to 3. We had lots and lots of airline companies that whittled down to a handful. We still have a couple out there that come and go. And it'll be interesting to see if crypto kind of follows that same trend to some extent.
So I have a Coinbase account, and then you get the updates, right? And it's like mover on Coinbase, and you look at it, and it's still 0.00000 like 3. It's moving, but it's like worth nothing, which is crazy. So there's so many of those out there. Right. So that's got to consolidate at some point, right?
At some point, but there's still so much fraud and malfeasance and things like that out there. I mean, you had the big one with Sam.
Yeah.
I can't remember. I always forget his last name. Oh. That happened years ago, and so you had another one here just recently to where I think 3 guys in one of the foreign countries had essentially turned it into a Ponzi scheme, and were promising people this and publicizing what the currency was worth and ended up breaking that up, I think, in the last 2 months. And so there's still just a lot of uncertainty there, but we get the question so frequently, and my answer would be this to some extent is we talk about risk all the time, and you have different levels of risk, and in my mind, something as unregulated and with so much uncertainty and fraud, that brings the risk level to a completely different level on there. And so if we're trying to hit a very important goal in your life, I want to live on $5,000 a month or some dollar amount in retirement, and I'm going to retire in 7 years, and you've got your goals fairly well defined, then what role does that really play in your investment portfolio? And my answer is going to be it depends on what your net worth is and how much money you have to where you can afford to carve out a certain amount of that versus not. One of the other trends I've noticed is most of those questions are coming from a younger age demographic or a lower socioeconomic graphic.
Oh, interesting.
Is where for me personally, and I can't talk about the industry, but for me personally, that's where I'm getting the vast majority of those questions is from those 2 types of demographics.
So the ETFs that I found that include cryptocurrency, are these non-regulated or are they regulated yet?
So the first one was just passed and was regulated in the last, I think, month or so. Mm-hmm. However, that being said, it's still not in every state. So even though it's allowable on the market, that doesn't mean that every state securities division has approved that in those different states. And so there's still a lot of gray area as far as, can I do it in my state? Can I do it in my state? Can I do it in this investment account? And so most of the major investment firms are still steering clear of that for the time being. I would expect that to change over the next 24 to 36 months.
Yeah.
And I would expect some of that to hit a little more mainstream at that point, but I also would expect that to coincide with a lot more regulation on how that's being handled.
Okay. Interesting. Brandon?
Very reminiscent of the penny stocks, and why are you buying this penny stock? Well, I don't know, right? Like, because if it could do this, then and it's like, no, there's no, like, what is the reason?
There's no earnings.
Right. And there's 0 earnings on the crypto stuff. And so I don't know. It's very, there's such a difference between an investor who's a long-term investor who's acquired and amassed wealth, and they want to be invested in society and make sure that they're in places that are going to consistently provide returns, right? Yes, there's volatility in the markets, but there's that consistency of the earnings and dividends and things like that, versus a lot of times the cryptos feel like people just trying to like, what if? It's very, very reminiscent of the lottery, or of, what if, and it's just like, that's not, there's no way Rex and I would ever approach someone and be like, hey, we're going to buy this stock because what if, like that just doesn't make sense. And so we're not looking for the what if 1 in 1,000 scenario. We're looking for the very real probability of averages over a long period of time that we can depend on a lot more.
Okay. Very interesting. So we're looking at trends in financial planning for 2024. And I want to know, Rex, what hasn't changed over the years?
I think people haven't changed drastically over the years. And so I think people are, make very similar mistakes today that they made 10 years ago, that they made 20 years ago, that they made 40 years ago.
Emotional mistakes?
Yeah. I think the vast majority are emotional mistakes. And I think, I'm not sure that that's ever really going to change, and so people, want to discover things for themselves, and they want to touch the hot stove sometimes.
Brandon?
I think that was great.
Don't be touching the hot stove. You go. Come on. Very good. Rex, thanks so much for your time here today. Brandon as well, for spending your time with us on Through the Pines and giving us your information, feedback on some of the trends that are happening in 2024 in financial planning. I find it fascinating. Business always moves forward. You have to always be improving. And so I'm assuming, that includes financial planning. So.
Yeah, always learning, always educating, always trying to stay on top of what's out there, and yet stay grounded with what we know today, because that's what we need to be basing our decisions off of, is what we know today. We're here for you, planwithbaxter.com.
Yeah.
If you have questions, or obviously you can listen to this podcast on any number of channels.
As many times as you want for free.
Unlimited.
Actually, yes. In case you missed something the first time, just keep listening. So, thanks again, planwithbaxter.com for more information. Also, you can find Through the Pines on YouTube. So if you're listening to this on audio, you can watch our wonderful, beautiful faces, or see our wonderful, beautiful faces on YouTube. Find us on Facebook and Instagram at Pines Podcast. That is a wrap on this episode of Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams. Yay.